This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Tian's picture that says Looking for the Downloads. Eric, let's cover crude oil starting with the EIA inventory numbers.
EIA printed a massive 5 million barrel build on commercial inventories. But hold on a second. It was really only a 2.5 million barrel build because another 2.4 million barrels was pilfered out of the Strategic Petroleum Reserve this week. That's the 7th week in a row that we've seen a drawdown from the Strategic Petroleum Reserve. 12 million barrels over the last 7 weeks have been taken out, and this is at the very time that they promised us they would be refilling it. Needless to say, our predictions here on MacroVoices that refill wasn't really going to happen as promised are already being proven right. Cushing, Oklahoma, building a massive 1.5 million barrels. That's a very big build for Cushing in a single week. I'm guessing there must have been some kind of disturbance on the pipelines that caused that accumulation of oil, but I don't have any specific data to explain it. Gasoline drawing down 1.4 million barrels, and distillates building a de minimis 80,000 barrels. U.S. production ticked back down 100,000 barrels to 12.2 million barrels. Tape action was up after inventory despite the build, taking us above the short-term moving averages, above the 200-month moving average, and starting to test the 21-day moving average up at 73.27. So we're above the short-term moving averages. Maybe that means there's hope for a new uptrend. But after so many of those uptrends have failed before and the recession signals are now getting louder and louder, I see plenty of room for another leg lower before the bottom is in for this market. And the 100-month moving average all the way down at 59.47 is the most obvious target that I see on the WTI chart. My original forecast that oil prices ought to be rocketing much higher by now has clearly been proven wrong. But I haven't changed my view on the underlying reason for my premature call, and I still forecast that an explosive move higher in oil prices is coming eventually. But with recession signals gaining traction and China's recovery not resulting in oil demand growing as quickly as expected, it's entirely possible that oil prices drift lower for another year or longer before what I'm talking about eventually takes hold. But I'm not abandoning my view. I'm convinced that it will eventually take hold. Now, I've described this before on MacroVoices, but for the benefit of any new listeners, let me just lay out my basic supply-side thesis, which is I think that the most important moment in the history of the modern oil market will probably occur in 2023 and go completely unnoticed. The event that I'm talking about is the world running out of spare production capacity. The reason that this monumentally important event is likely to go completely unnoticed when it happens is that if demand is declining, then the market's inability to accommodate an increase in demand will not be tested. Nothing will happen, and oil prices might just continue to drift lower. But someday the recession cycle will play out, and demand for crude oil will return. That demand will not be met because we simply don't have the supply. We don't have the inventory cushion to absorb a big supply-demand imbalance, nor do we have the spare capacity needed to increase production in response to higher prices and increasing demand. Crude oil prices are famously inelastic to supply to start with. The reason is that when you have plenty of spare capacity, it takes time for higher prices to transmit to a human decision to increase production, and then there's a lag time for that increased production to reach first the country that the oil is being delivered to. It's got to go through the refining process. Finished products have to be delivered to whatever city they're going to be consumed in, so on and so forth. Even when you have plenty of spare capacity, this is a challenge. But when you don't have any spare capacity, and this is the first time that the oil market is going to confront a situation where it doesn't have any spare capacity, higher prices don't transmit signals that increase supply. They just keep getting higher and higher and higher, and there is no supply to increase. And I predict that that's exactly what's going to happen the next time that the market is challenged to meet an increasing global demand, something that we don't have right now. The market will fail that test, and then we'll have an energy crisis on our hands. But none of this gets triggered until the market's ability to respond to increasing global demand is tested, and we don't have that test yet. Some people think that global oil demand has already peaked and begun an irreversible decline. Now, if they're right, then the market event I'm talking about might never happen. But if they're wrong, and I think they are, then we're headed for a global energy crisis by 2030. Now, this whole thing is reversible with a change in policy and more investment in E&P. But there's a multi-year lag time for that fix to be applied. And during that lag time, nothing can be done to stop the global energy crisis that's going to happen during that lag period. I thought this was all going to start this year. I'm starting to think now that we're going to have a year or more of recession before it eventually hits the tape. But I remain convinced that eventually we're going to see increasing global demand that cannot be met with increasing supply, and it's going to cause a major, major price dislocation.
Yeah, it's been interesting price action, Eric. Obviously, the lows from March held on the test, and crude oil is really settling in and bouncing off of those lows. But to me, the real test is whether or not it can come back into that trade range in the high volume node zones that were established through December and January, February, March. And if we see crude oil here fail to make any push deep into the mid 70s, then it's still technically quite weak. And the window can still remain open for one more retest on the downside, in my mind. Overall, there will obviously be a point where crude oil will bottom and create a buying opportunity. But at minimum here, if the bulls want to give it a shot now, they're going to need to get back into this trade range. And that's 100% what I'm going to be watching going into next week. Nonetheless, let's move on to equities. Before we get to you, Nick, in terms of the levels, I wanted to get your thoughts here on the markets, Eric.
No big change from last week. I think the next big move for stocks is going to be down. But I won't be surprised if they drift up first. Now, if that happens, my target is around 43.09, which is the 61.8% fib retracement of the overall bear market. I don't think it's going to go much farther than that, but let's see what happens.
Yeah, Nick, on page 3 here, we have the S&P 500 levels. What are you watching going into this week's OPEX?
Yeah, Patrick, the spot right now on SPX is 4160 with a call wall above at 4200 and a put wall below at 4000, which has moved up from the previous level by about 100 points or so. The implied move for the June 16th OPEX is plus minus 140 points. So the upper expected move is 4300 and the lower expected move is 4020 roughly. Key resistance above is 4200 and then 4300, which is also the year high. And key support below now is 4150, then 4100, then 4050. Again, I mentioned last week that I was bullish in the short term, and that's still the case. I think we see upside toward 4,200 or so, but that may not transpire until after this Friday. I think volatility will pick up a lot in the coming weeks as we approach the June OPEX as well. And I'm also noticing that there's a serious skew right now to the upside with the calls and the puts. The calls are much more expensive than the actual puts right now by a factor of about 13% or so. So that's kind of interesting to note. I attribute it to a factor that right now, a lot of funds are underinvested in equities, so the hedging requirements are not as high. So the put buying is not as necessary for hedging purposes. So again, right now I'm short-term bullish, but I'm a long-term bearish. I think we can touch that 4,000 level in the next few months as well, and then possibly test out the 3,800 level again, which we saw a few months ago.
Yeah, on page 4, I have the S&P 500 chart. And the one thing, while we were talking about how heavy the market is and how weak the breadth has been, that was a part of last week's postgame. The interesting thing here is that the pain trade, actually, in my mind, is really the market first going higher before it goes lower. There's clearly every reason why this market has a chance to go down during a recessionary period. But it going first towards 4,300 to kind of just wash out all the shorts and to sucker in a bunch of new buyers up to push it up to the upper zone is still, I think, the path of least resistance on the short term. The 4,100 level is a really interesting place. It's where that 50-day moving average is. And I think overall it's an area where it'll be the first sign that some sort of reversal is underway. And right now we're nowhere near it. So it'll be, let's see whether the bulls can follow through above this 4,200 overhead resistance. Nonetheless, let's move on. On page 5, we have that NASDAQ QQQ. What levels are you watching?
So spot right now on the Qs is 332. We have a call wall above at 335 and a put wall below at 310. The implied move for the June 16th OPEX is plus minus 13 points. Upper expected move is 345. Lower expected move is 319. Key resistance is just above the current level at 335, and key support is at 310, also where that put wall is right now. Again, big tech has been carrying the market higher for the past few months, really for the past year actually. And looking at Google, Microsoft, Apple, Amazon, and Meta, they've been carrying the brunt of the load overall. I believe when I analyzed the equal weighted index versus the current index, you can see that right now, most of the gains in the market have been attributed to just about 5 to 7 companies or so, with NVIDIA and AMD being part of that number as well. But right now, again, I'm bullish as long as these names hold up. But the one thing that concerns me is looking at Apple and Microsoft, for example. They're near all-time highs right now already, whereas their valuations are much, much more expensive relative to previous years when they hit all-time highs, because their earnings are actually lower than they were prior. So that to me is a bit of a concern going forward. And I think that we could see some downside perhaps if these big names start coming down or stagnating overall.
I have to agree with you. The only thing I think that can really get this market up to 4,300 and 4,400 on S&P is if the breadth widens. Really, those mega cap stocks are pretty exhausted. It's not that they can't go higher, but it'll be really hard for them to continue to carry all the weight. And so it's interesting, on page 6, I have the Russell, and the small caps have actually upticked yesterday and over at least the last couple trading sessions. And a part of that, I think, is a bounce in those regional banks. And so if there was going to be an impulse higher in the short term, it could and should likely come on the back of a widening breadth of the market. And if it doesn't, then I don't really know if the market will have enough gas in the tank to make that push. Nonetheless, let's see whether or not the small cap rally sticks. On page 7, I want to move on, though, to the volatility. The VIX down in the 16 handle, holding down along the bottom of the range. What are you thinking here, buddy?
Yeah, so looking at the VIX, again, right now, as I mentioned in past weeks, I don't really attribute a lot of importance to it as I do to the 0DTE, so the one-day VIX right now, because we're seeing about half of the flows come out for 0DTE options. The VIX right now is at about 16.76 or so, almost about 17, which gives us an expected move daily of about 1% in broad indexes. So right now, that 20 area is very important. We spiked a couple days ago to that 20 area and came right back off of it. It's possible we go lower as we grind higher to that 4,200 mark on SPX, or even 4,300 perhaps. But it's much, much harder to swallow the pill of selling premium when it's not that high right now. That is the VIX, because the reward isn't that great for the risk being taken right now. Until something happens, some catalyst event occurs to spur some downside, I don't anticipate on a huge spike in the VIX. I think we can kind of stagnate in this area and kind of slowly grind higher perhaps in SPX, while the VIX kind of remains in a very inert phase overall. That's my perspective in the short term. Again, if we get above that 20 area with some gusto to the downside in broad markets, it's possible we spike to 25, 26, and then depending on the catalyst event, it's possible we push to a 35 handle or so. Now, moving on to the US dollar index on page 8, what are your thoughts here?
Well, clearly the dollar is firming up, but there's a big difference between firming up and declaring a new uptrend. We need a daily close over 105 on the Dixie to declare a new trend, and we don't have that. So we're still consolidating in a fairly wide range between 100 and 105 until proven otherwise.
Yeah, my view on it was that the dollar was going to put in a short-term low, even if we had a quick little drop to down to the 100 level. My overall view is that we are far more range-bound. But what will be interesting to see is if we do have some sort of a indication that, that a recession is actually here, if we do have a risk-off impulse, will it drive a short-term dollar impulse that could even break this trade range and even head to a little bit of a higher level like 107 or 109? While I understand that overall the dollar likely will, in the years to come, weaken off of these levels, the question here is whether or not it first has a journey to the upper boundary of the ranges before it goes down. Nonetheless, this 103, 104 level is where there's a lot of fib zones. It'll be interesting to see what the dollar does as we approach a typical retracement area.
Now, guys, moving on to page 9 here, we have the gold futures chart. What are you guys thinking here?
Well, now things are finally starting to get interesting in the gold market. As I've been saying for several weeks now, just breaking out from here to new all-time highs and up and away would have been far too easy. The fundamentals for gold are excellent. But as Tianyang said in the feature interview, long gold has become a crowded trade. I wasn't aware of the LPPL signal predicting a top on gold last Friday until this interview, but it fits perfectly into my own view that the market needs a painful correction to shake out the weak hands before a breakout to new all-time highs can be sustained. So now it seems the long-awaited correction is on, and the question becomes, how low will it go before bottoming and moving higher to reassault the all-time highs later this summer? My chart shows the bottom of the price channel and the 100-day moving average approximately co-located around 1931, and that's been my target for adding to my longs. But Tian's scenario of a deeper correction makes perfect sense. Everyone knows that the fundamentals for gold couldn't be better, and they're right about that. But they're all right about that on the same side of the boat, and that always spells trouble. Right as they may be, I think some of them are perhaps about to take a swim. So it makes sense to keep some powder dry in case of a deeper correction.
Yeah, Eric, overall, that 1930, 1925 area is an area of high interest for me as well on the first pullback. But in my mind, if we go through a bigger risk-off impulse, I think that the vulnerability of gold even pulling back to retest March lows near 1800 is entirely on the table. But I'll have to be in the stance that I remain quite bullish in the bigger picture. And if we had that deep of a pullback, it would be a compelling and a tactical opportunity to reposition on the bull side of gold. So it'll be interesting to see how that plays out. Nonetheless, I want to touch on page 10, 11, and 12 of the grains. I have wheat, corn, and soybean futures. And what's really interesting to point out is just how incredibly weak the grains have been. They're breaking down, many of them to fresh lows, and just continue to be incredibly weak. This continues to contribute to the overall weakness in the Bloomberg Commodity Index, as everything, including oil, have been pressing that index down. It'll be really interesting to see whether that break in the commodity index will inevitably result in a buying opportunity that will arise in the second half of the year. But right now, these trends are distinctly down and very weak charts that continue to leave the downside window open.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from bigpicturetrading.com, the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.